What's up everybody, Gen X Dividend Investor here. In this insightful video I respond to a subscriber who was wondering if McDonald's is a bad dividend stock since it has negative shareholder equity, and I strongly encourage you to watch this whole thing as I'll cover a bunch of topics that'll help make you a more educated investor. Near the end of this video I'll tell you a funny anecdote that just happened to me, and I'll share some more interesting info about that buddy of mine and his inheritance. But first a quick disclaimer, which is that I'm long McDonald's stock with a six-figure position that is about 4% of my dividend portfolio, so take that into consideration as I talk about it. And with that being said, let's dive into things. So shareholders' equity is a company's net worth that is equal to the total dollar amount that would be returned to shareholders if a company was liquidated and all its debts were paid off. This shareholder equity is equal to a company's total assets minus its total liabilities, which is why it's something that many investors and analysts often look at when trying to evaluate a company's overall financial health. A negative shareholder equity is often seen when a company owes more money to its investors than its assets can cover, which is why I like to see a company's assets growing faster than its liabilities. Let's take a look at McDonald's shareholders' equity over time using Seeking Alpha, and note I'm sponsored by them. If you Google Seeking Alpha McDonald's and click on the first return link and then you click on the Financials tab, you'll see their income statement looking like this, assuming you're on a free account. The shareholder equity metrics I'm going to look at are on the balance sheet, so let's click on that. It begins with cash and short-term investments, and the closest column on the left is from the year 2013, then each column going out to the right is another year. The older years of data aren't visible on free accounts, so I'll jump on my premium account to see it all. You'll notice that I've got dark mode on and I've ordered my dates to have the first column being the most recent year, with each column going to the right being further back in time. Now if I scroll down a bit on the balance sheet, we come to stockholders' equity, and this highlights what the subscriber's concern was. The legend on the bottom will tell you that these numbers are in millions of dollars, and whenever you see a number in parentheses on a financial statement, it means it's a negative. So this is saying that in McDonald's last report, they had negative $4,854 million worth of stockholders' equity, which is negative $4.8 billion. In 2022, they had minus $6 billion, then in 2021, they had minus $4.6 billion, then in 2020, they were at minus $8.2 billion, then minus $6.2 billion, minus $3.2, minus $2.2 in 2016, then positive $7 billion of shareholders' equity in 2015. Basically, McDonald's shareholder equity has been negative for the last 8 years. To double check those numbers, let's quickly look at assets and total liabilities. So on the last report, it shows that total assets were at $52 billion. Down below, we see their total liabilities were about $57 billion, and 52 minus 57 is a negative 5, so indeed their shareholders' equity is currently about minus $5 billion. And looking over these total liabilities over time, we can see how things have been getting more negative, and growing debts and such are often something to keep your pulse on. I mean, some debt is fine and often appropriate, but too much debt can become problematic, so figuring out what a company can handle is helpful. Okay, now let's dig into why McDonald's shareholders' equity is negative, and to answer that we need to understand their business more. One big thing to realize, and I think that many McDonald's investors do realize this, is that McDonald's is a real estate business much more than a burger business. In fact, their old CFO, Harry Sonnenborn, once said, "We are not technically in the food business, we are in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue from which our tenants can pay us our rent." End quote. The fact that he said 15-cent hamburgers tells you that this was decades ago, as today a hamburger runs about $2.40. And in fact, it was Sonnenborn who approached the famous Ray Kroc with the concept of McDonald's owning the land that their restaurants were to be built on and then leasing that land to the franchisee. That business model led to the explosive growth of McDonald's and might have been the most important financial decision in the company's history. I read that McDonald's real estate represents something like 99% of the assets on their balance sheet, along with over a third of their annual revenue. So while burgers and fries might be what we think of when someone says McDonald's, us investors also think of land and rent. These days, there are over 40,000 McDonald's locations in over 100 countries around the world, though franchisees run over 90% of them, and the reason why McDonald's itself doesn't run more of them will become apparent. And I'm guessing someone will leave me a comment about how bad their food is for your health, or maybe how bad you think it tastes, but I've loved it since I was a kid. I mean, I still look forward to getting a cheeseburger, fries, and a Diet Coke meal, and in fact maybe I'll celebrate today and have some McDonald's delivered to me while I work on this video. Anyway, franchisees often sign up for 20-year agreements, and beyond rent, they also pay royalties and advertising fees and capital expenditures and stuff like that. It usually takes a potential franchisee being able to pay $1 to $2 million to start a new location, and 40% of that money must come from non-borrowed funds, so cash in the bank or cash you raise from selling stuff, and the rest you can borrow. Ultimately, McDonald's wants and needs their franchisees to be successful, and some franchisees do quite well and eventually open up multiple McDonald's. Now, McDonald's management realized a few years ago that its company-owned locations made good revenue, but it was their franchisees that actually made the most profits. And because of that, they decided to embark on a strategic shift of owning fewer corporate-run McDonald's and instead let franchisees do it. That also meant that they were purposely embarking on a path of less revenue but more profit. So with that understanding, you might now come away with a different take when you look at McDonald's revenue and income trends. What we see is that its trailing 12 months revenue was $24.68 billion, and the year before it was $22.8 billion, then again $22.8 billion, then $18.8 billion in 2020. If we look at gross profit, then we can see this last year was its highest at $14.3 billion versus $13.2 billion the year before that, $12.5 billion before that, and $9.7 billion before that. And then from 2019 to 2013, the profit was around $10 billion a year. So their goal to push profits up started to materialize in the last few years, as well as revenues started stagnating relative to where they were a decade ago. TLDR, I find it helpful to understand why numbers are doing what they're doing, and not just what they are. I mean, someone might look at their revenue trends and think, wait a sec, McDonald's revenue today is like 10% under where it was 10 years ago? What a crappy business. But what they don't understand is how McDonald's management purposely exchanged the low margin revenue of food sales for the higher margin business of franchisee fees and rental income. And so not only has their gross profit counterintuitively gone up, but now check out their earnings per share from their income statement. What we see is that their trailing 12-month earnings per share is at $11.42, and it was at $8.39 last year. Then it meanders up and down a bit going back through time until we get to 2013 when it was only $5.59 per share. So McDonald's strategies are working, and as I often say, stock prices tend to follow earnings, so even though revenue trends look weak and shareholders' equity looks weak, take a look at McDonald's stock price over the years. What we see is that it's been trending up since the dot-com crash. And if we look at McDonald's total returns on Seeking Alpha, which is stock appreciation and dividends, and we compare that to the S&P 500 over the last 10 years, we see that McDonald's has had a total return of 293% in the last decade, beating out the S&P 500 that returned 213%. Thus, yes, McDonald's has been outperforming over that time. And with that behind us, let's go back to understanding why shareholders' equity looks crappy. And a disclaimer, I'm not an accountant, so I'm just telling you my non-professional perspective of what I see. Specifically, it's around GAAP accounting and how the book value of assets can be quite different from today's value of assets, which can be a contributing factor for seeing negative equity. What I mean is that real estate can show up on a financial statement at its original cost versus its current market value. But do you think that maybe McDonald's real estate has appreciated over the years? I mean, some McDonald's have existed since around the 1950s, and do you think its real estate is worth more now than it was back then? One insight that might help paint the picture more is to look at the accumulated depreciation and amortization section listed here. And sure, there are pros and cons of GAAP versus non-GAAP accounting, but instead of going into those, let's instead look at another thing which isn't reflected on the negative equity, which is the value of McDonald's brand itself. You see, brand is not part of the balance sheet nor part of any financial statements. Brand is something that's built up over the decades, but under GAAP accounting, brand has no book value. I mean, it's an intangible asset, as is a company's intellectual property and goodwill, but it cannot be easily accounted for in a company's financial statements. Yet think how valuable their brand actually is. I mean, McDonald's could probably go to any bank in the world and get a loan at very low rates because they're such a trustworthy and established institution. So what is their brand worth? Maybe $10 billion? 50? 100? Whatever it is, my point is that there's more to McDonald's shareholder equity than what you see on its financial statements, and I'd argue that there's actually a ton of equity for shareholders when everything is taken into account. And an interesting question to then ask yourself is if you believe the return on equity is compelling as an investor, but I'm not going to jump into that as we still aren't done with shareholders' equity. Another thing we got to understand about McDonald's is that their management has been buying back stock at a strong clip. Like, take a look at this part of the supplemental income statement. What we see is that they have about 729 million shares outstanding right now. Going back a few years to 2017, they had even more shares at 800 million. Then further back in 2015, they had 939 million and around a billion shares outstanding in 2013. So they've spent billions of dollars on buybacks and reduced their share count from a billion shares down to 729 million shares in the last decade. Now, I'm one of those people that prefer dividends, but I also like buybacks as they also help dividends along with can help share price. Remember, dividend payments and share repurchases are the two main ways for a company to return cash to its shareholders, and while dividends represent a current payoff to an investor, share buybacks represent a future payoff. What I mean is that as shares are taken out of circulation, then each of your remaining shares are worth more and your earnings per share go up, and since stock prices basically follow earnings, then that's how buybacks can help act as a way to push stock prices up. But how do buybacks impact shareholders' equity? Well, on the balance sheet, a share repurchase reduces a company's cash balance and its total assets by the amount of the buyback, along with will lower the shareholders' equity on the liability side. And then in terms of helping dividends, what I mean is that buybacks make dividends more sustainable because there are less shares that the company has to pay dividends on. Like if a company had 100 shares outstanding and it paid a dividend of $1 per share per quarter, then that means each quarter they'd pay out $100 in dividends or $400 a year. But if they bought back and retired 10% of their shares, then they'd only have 900 shares outstanding, so now their quarterly dividend payout would be $90. That's why each buyback makes their dividend more sustainable, as well as gives them room to hike their dividend more. Like that company with 90 shares outstanding could then do a dividend hike of about 11% to get back to paying out about the same amount of dividends they were doing before the hike and before the buyback. So don't be so quick to say you hate buybacks if you like dividends, because they help divvies out as well. Now, another metric I like to look at for my stocks is their free cash flow per share. What we see here for McDonald's is that their trailing 12-month free cash flow per share is $9.86, an amount that has been trending up over time. Like if we look a decade back in 2013, we see that the free cash flow per share was only $4.30, more or less than half of what it is now. It's nice to know that each share I own in the company is cash flowing more money that is going into my pocket with its growing dividend. Another useful trend that we dividend investors like to look at are payout ratios over time, and Seeking Alpha's income statement lists that information, which isn't something you normally see on income statements. What we see is that McDonald's is at a healthy 53% payout ratio right now, and you can see how it's moved up and down a bit over the years, and buybacks and earnings have all helped bring that ratio down, even as dividend raises have been pushing it up. And all that info helps paint the picture as to how McDonald's has paid out and increased their dividend for every year since they first started paying one in 1976, and helps explain why McDonald's has been a great dividend stock to own. Now there's a lot more I'd dig into if I was looking to invest into McDonald's, but hopefully that gives you a sense of some of the things I look at. And beyond looking backwards in time, what investors really care about is what they think their future will bring. I mean, it's great if a company has a rich history of strong financial metrics and solid total returns, but can it keep yielding good returns in the future? Is the company continuing to invest and innovate in a way that will yield results? With McDonald's, I think the answer is yes, and this tweet I recently shared on X is an example of how McDonald's may accelerate their growth. I shared a link to an article that talks about how McDonald's launched a spin-off restaurant called Cosmix, which has a 1980s alien robot vibe to it based on some old McDonald's characters. The first Cosmix just opened in Bolingbrook, Illinois on Thursday, and it has some new menu items on it along with some old ones. Their drink menu kind of reminds me of a cross between Starbucks, Dutch Brothers Coffee, and maybe a hint of Jamba Juice. Like some Cosmic drinks have energy shots and ginger shots in them, and they have classic drinks like lattes, iced teas, and lemonades. They also have established McDonald's food items like sausage egg McMuffins and hash browns and such, along with will carry new items including a spicy queso sandwich, a creamy avocado tomatillo sandwich, and snack foods like pretzel bites and such. Only time will tell us if this new idea will be a good catalyst for McDonald's growth, but what I like about it is that they're still innovating and trying new things. This Forbes article that just came out mentions that McDonald's is planning for its fastest period of growth in brand history, with a goal to open 10,000 new stores by 2027. Insane. The article also talks about a new partnership McDonald's formed with Google to automate its restaurants using AI. McDonald's also has other initiatives planned to improve things, such as one to enhance the quality of their food. All in all, I'd not be surprised to see 10% annualized earnings growth out of McDonald's over the next 10 years, though right now I think the stock is too pricey. But there's also some problems they gotta deal with, because all companies have issues and risks and such. And beyond a pricey stock, I think a bigger issue is that McDonald's menu items seem too pricey to me. I mean, we all miss the days where the dollar menu actually let us buy stuff for $1, and inflation and profits have me wondering how much more price hikes consumers will tolerate. McDonald's used to be about fast, cheap, good-tasting food, and now cheap is kinda gone. Another issue they may be contending with is a more educated consumer who is also health-conscious, though so far that's not seemingly mattered. But as automation takes hold, I think it'll make things better, faster, and even cheaper. Like better could come from more consistent food and drinks, faster from less human involvement, and cheaper if automation works and displaces labor. Sidebar, I think in the next few decades it'll become inevitable that UBI will be instituted as robotics and AI replaces far more jobs than it creates, but hey, what do I know? The bottom line TLDR for me is that McDonald's is an amazing dividend stock, and I think its future looks brighter than its past, and I'm betting it will yield nice returns for my family and my future generations I hope to someday have. Okay, now I want to change gears and tell you about this exchange I just had with my wife. So we live in a house with a pretty small garage, and she parks in it. One time she didn't pull far enough in when she was parking, and the garage door almost hit her car as it was closing. So I hung up a piece of string hanging from the ceiling to the floor that she could use as a guide to move her car up to. And when my wife walked in the house yesterday after parking, I asked her, is it all the way in? To which she started cracking up after responding, that's what she said. Okay, and then another quick tidbit I wanted to tell you about is some additional info I learned from that buddy of mine who just inherited some money and was using some of it to get a sports car. Well, yesterday I found out that he also inherited a new 401k, and since I've never inherited anything, I thought it'd be interesting to see how that works. Apparently there's 3 choices of what he could do with the new 401k. Number 1, he could have transferred the funds directly from the 401k into an inherited IRA account, and then all that money would need to be withdrawn within 10 years. Number 2, he could take a lump sum distribution out of it, which may incur some taxes. Or number 3, he could leave the money in that new 401k and then withdraw it over the next 10 years, due to the requirement to withdraw inherited IRAs within 10 years. My buddy and his wife opted to take the lump sum distribution, and his wife actually went to a Fidelity location and then wired everything in the 401k out of their checking account, and they plan to spend it rather than invest. So please leave me a comment and tell me which of those 3 options you'd have done, as well as what you'd have done with the money if you took it out. If it were me, I'd probably spend 25% of it and save and invest the rest. I found that delaying gratification is integral to building long-term wealth, or really to achieving any sort of long-term gains in whatever you're doing. And with that, I'd like to close things off, so if you appreciated this video, then please show me your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. Also, please consider following me at GenXDividend on X. Now, I'd normally shout out my newest Patreon Aristocrat and King signups, but I'm still all sold out. What I'll do instead is take a moment to recognize my All-Star Patreons with a shout-out, i.e. those supporters that sign up or have been signed up for a year or more and that continue to stay on board. First, I'll show you my longtime Patreon Kings, which are my highest tier of supporters. Then I'll show you my longtime Patreon Aristocrats. And finally, I'll show you my All-Star Patreon Champions. Thanks, folks. I really appreciate your long-term support. I'd also like to thank Seeking Alpha, who sponsors me. Consider using my Seeking Alpha affiliate link in the description of this video, as using it often comes with benefits for new member signups. And as always, I highly recommend that you join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 76 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.